Welcome back. This video will cover the weighted average cost flow assumption. I know this series is long, but the next few videos will be brief. The weighted average cost method is performed a little differently from LIFO and FIFO, but it's also much easier and quicker. All we'll do is calculate an average cost per unit and use that average cost to record our cost of sales. The weighted average cost is calculated as follows. We take the total cost of inventory on hand and divide that number by however many units of inventory we have on hand. We will perform this calculation every time we make a purchase. We'll then use that calculated average for every sale until the next purchase, at which point we recalculate the average cost. Let's look at the same sale and purchase transactions as we used in the FIFO and LIFO video. We'll now perform the cost flows using the weighted average cost method. We'll mostly use the same table format as we did under the FIFO and LIFO methods. We begin by listing our beginning inventory units, cost, and balance under the inventory balance column. On September 4th, we purchased 120 units at $6.90 per unit, so we'll debit merchandise inventory and credit accounts payable for $82,800. For simplicity's sake, I'm presuming all sales and purchases are on account. We'll incorporate this purchase with our beginning inventory. We now need to calculate our weighted average cost per unit. We sum the $26,800 with the $82,800 to get our total cost of inventory on hand, $109,600. How do we figure out the number of units on hand? Add the 40 units from beginning inventory to the 120 units we just purchased to get 160 units on hand. We then divide the former by the latter and arrive at a weighted average cost of $685. On September 7th, we make a sale of 60 units at a sale price of $1,120. We'll debit accounts receivable and credit sales for $67,200. For how much will we debit cost of goods sold and credit merchandise inventory? We take the 60 units we sold and multiply that by our weighted average cost of $685 to get $41,100. How much inventory do we have left? Well, we had 160 units and we just sold 60 units, so we have 100 units left at an average cost of $685, or $68,500. On September 15th, we have another sale of 50 units. As above, debit accounts receivable and credit sales for $56,000. We'll also debit cost of goods sold and credit merchandise inventory for the 50 units sold multiplied by $685. Again, we keep using the same weighted average cost. The amount for our journal entry, $34,250. We previously had 100 units on hand and we just sold 50 units. So we have 50 units left at $685, or $34,250 worth of merchandise inventory. On September 18th, we make another purchase of 100 units at $700 per unit. So we debit merchandise inventory and credit accounts payable for $70,000. As I said previously, every time we make a purchase, we need to recalculate our weighted average cost per unit. We had $34,250 of merchandise left after our previous transaction, and we just acquired $70,000. So our total cost of merchandise after this transaction is $104,250. And our total units available is 150 units. Divide these two together, and we arrive at a weighted average cost of $695. On September 21st, we have a sale of 80 units at a sale price of $1,120. Debit accounts receivable and credit sales for $89,600. To get our debit to cost of goods sold and our credit to merchandise inventory, we multiply our 80 units sold by the new weighted average cost of $695 per unit. The amount, $55,600. If we previously had 150 units on hand and we just sold 80 units, we have 70 units left at a weighted average cost of $695 per unit, for a total inventory balance of $48,650. We then have our last sale of the month on September 25th of 30 units. Debit accounts receivable and credit sales revenue for $33,600. Debit CGS and credit merchandise inventory for the 30 units multiplied by the weighted average cost of $695 per unit. Total amount, $20,850. We now have 40 units left at that weighted average cost of $695, or $27,800 of merchandise inventory. Our very last transaction for the month is a purchase of 120 units at $707 per unit. Debit merchandise inventory and credit accounts payable for that product of $84,840. Since we made a purchase, we need to recalculate the weighted average cost per unit to use going into October. We take the $27,800 of merchandise that we currently have on hand and add to it the $84,840 we just purchased, and our total cost of merchandise inventory is $112,640. Total units available is the 40 units plus the 120 units, or 160 units. Divide the $112,640 by 160 units, and we get a weighted average cost of $704 per unit. Were we to begin our table for the very beginning of the next month, October, we would only show the 160 units on hand multiplied by that new weighted average cost per unit. Just as we saw under FIFO and LIFO, we can use our formula of beginning inventory plus purchases equals ending inventory plus cost of goods sold to verify that our numbers look to be correct. Beginning inventory was $26,800. Our purchases consist of $82,800, $70,000, and $84,840. Ending inventory was $112,640. Our cost of goods sold amounts consist of $41,100 plus $34,250 plus $55,600 plus $20,850. Work these additions out, and we have $264,440 equal to $264,440. So we can be reasonably confident that our numbers are correct. We can summarize the results of the FIFO, LIFO, and weighted average cost methods as follows. Here we see the amounts for beginning inventory, purchases, ending inventory, and cost of goods sold from the previous three examples. FIFO and LIFO were covered in the immediately preceding video. We can simplify purchases, and more importantly, cost of goods sold, into the following values. As covered in the intro video to cost flows, under a period of inflation, FIFO will yield the highest ending inventory because its ending inventory consists of the more recently purchased inventory, which was acquired at a higher cost. For this same reason, cost of goods sold will be lowest under FIFO because the earliest purchased inventory with the lowest cost is deemed sold. The benefits under the FIFO method are that ending inventory more closely aligns with its actual value since it uses the more recent costs. Furthermore, since cost of goods sold is highest under FIFO, FIFO will provide a higher net income on the income statement. Under LIFO, the pattern reverses. Ending inventory will be lowest under this method because ending inventory contains the older merchandise inventory with the lowest cost. Cost of goods sold will be highest under LIFO because the more recently acquired inventory with the higher cost is considered to be what was sold. LIFO gives the most accurate cost of goods sold valuation since that number consists of the most recent values. Since cost of goods sold is highest under LIFO, LIFO will also result in a lower net income, which can be an advantage if you are trying to lower your company's income tax liability. Since the weighted average cost method is an average, this method's numbers will fall in between the LIFO and FIFO results. The weighted average cost method is often said to smooth out erratic cost changes for this reason. That concludes this video on the weighted average cost method, as well as a summary of the results of our three cost flow assumptions. The next video will address the impact of inventory misstatements. Thank you very much for watching. If my videos are helping you and you want to return the favor, you can leave a thumbs up and/or a comment or question below. If you really want to help, temporarily subscribe to my channel. Not forever, just for however long you're taking your accounting course or courses. Finally, share my videos with your classmates and even your professor. I'd like my videos to help as many students as possible, and I wouldn't mind getting some feedback from contemporaries. Thank you very much once again, and I'll see you in the next one.